Welcome to the Opening Bell Report.
We've got a really interesting one on the desk today. It's pretty rare that we get to look at a company that is, simultaneously a complete financial disaster and a potential gold mine. It really depends on which lens you're using.
It's the Schrodinger's cat of the stock market right now.
Yeah.
Is it alive? Is it dead? You honestly don't know until you open the box.
That is a perfect way to put it. We're talking about FRMI Inc., ticker symbol FRMI.
Right?
And if you were watching the tickers today, you absolutely could not have missed it. The stock jumped 11.11% in a single session, closed right at $8.
Which, honestly, for a company that's had the year Fermi's had, that's a massive move. It wakes people up.
Exactly. And that movement brings up the big question we're trying to tackle today. Is this the start of some kind of legendary turnaround?
The kind people write books about.
Yeah, or is this just a dead cat bounce before the stock goes to zero?
And to figure that out, we have to look at a really specific set of data. We're not just looking at the stock chart here. We're unpacking a new analysis report that suggests some very large and, frankly, very predatory investors are circling.
The vultures.
The vultures. But remember, in high finance, vultures aren't necessarily the bad guys. They're just efficient.
Okay.
They see value in the bones when everyone else has run away screaming.
So our mission today is to figure out if you should be scared or greedy.
Yeah.
We're going to break down this whole asset play, the massive scale of Project Matador, and this fascinating disconnect between the company's bank account,
Which is terrifying.
and its asset base, which could be worth billions.
Let's get into it. Because on the surface, this looks like a clear stay away.
Right. So before we even get to the vultures and the smart money, we have to set the scene. If you just pull up FRMI on a basic stock screener, you might see technology or maybe AI services listed as the sector. But that's misleading, isn't it?
Oh, it's highly misleading. If you go into this thinking Fermi is writing code or designing chips, you are going to lose money.
Okay.
Fermi isn't an AI company in that sense. Fermi is a landlord. Or maybe, more accurately, they're a developer for the AI age.
And this is Project Matador.
Right. And to understand why people hyped this stock to the moon last year, you have to get your head around the sheer scale of Matador. This isn't just a data center. This is a proposal for an 11-gigawatt clean energy and hyperscale data center campus in West Texas.
I just want to pause on that number because it sounds like a sci-fi stat. 11 gigawatts.
It's hard to visualize, right?
Wait, I mean, for context, I looked this up. A typical large nuclear power plant produces about 1 gigawatt.
Maybe 2, if it's huge.
Exactly. So, FRMI is proposing a campus with the power capacity of, 5 or 6 nuclear plants all put together?
Exactly. It is a city-sized amount of power. I mean, it's more than some small countries use. And in the world of AI, power is the new oil. You can have all the NVIDIA chips you want. You can have the best algorithms. But if you can't plug them in, they're just expensive paperweights.
So, flashback to October 2025. FRMI hits the market. And the IPO narrative was it was perfect.
Yeah.
They said, we have the land in West Texas, we have the permits, and most importantly, we have the grid connection.
And the market ate it up. The stock ran to nearly $37. It was the absolute peak of the infrastructure frenzy. Everyone wanted exposure to the picks and shovels of AI, and FRMI looked like the biggest shovel in the shop.
But then, December happened.
The reality check.
And the crash was just brutal. I mean, the stock didn't slide. It fell off a cliff. It dropped from around $15 straight down, hitting a low of $7.18 just this week.
Wow.
That is a 78% collapse from the highs. And the catalyst wasn't some vague market sentiment. It was very
specific. It was the anchor tenant. See, when you build a project this big, 11 gigawatts, you don't break ground with your own money. You can't. You get a credit tenant, a Microsoft, a Google, an Amazon, to sign a lease before you build. That lease guarantees the loan.
And FRMI had one. They had a $150 million funding agreement locked in.
Until they didn't. In December, that tenant walked away. We still don't know exactly why. Could be timelines, could be grid delays, could be anything, but they canceled the agreement.
And that just shattered the thesis. Without the tenant, there's no funding. Without funding, there's no data center.
And without the data center, FRMI is just a company owning a lot of empty desert and paying lawyers.
Which brings us to the financials. I know you looked through the analysis report on their recent numbers. It's,
it is not pretty.
Not pretty is being generous. It's a horror show.
Yeah.
I mean, look at the top line. Revenue.
$0.
Yep, they're pre-revenue.
Yeah.
Which is coming for like a biotech firm inventing a new drug.
Yeah.
But for a massive infrastructure play that's been public this long, it's nerve-wracking.
But the bottom line that really scares me, net income is a loss of $346.8 million.
Operating income is negative $35.4 million. They are burning cash at an alarming rate just to keep the lights on.
And they do not have an infinite runway. The report estimates they have about, 84 million in cash left on the balance sheet?
Right.
And if you do the math on that burn rate,
They have less than a year. Maybe.
Right.
maybe significantly less, if they have to pay breakage fees or deal with all these class action lawsuits that are popping up.
Precisely. So let's just recap the doom case. You have a company with zero revenue, a canceled contract, a cash burn that gives them months to live, and the stock is down 78%.
And yet, and this is the part that just stops me in my tracks, the market cap is still $4.91 billion.
Nearly $5 billion.
How? In what world is a company with those fundamentals worth $5 billion? If this was a lemonade stand, it would be worth the wood the stand's built on.
And that is the multi-billion-dollar question. And that is exactly where we have to pivot to the smart money thesis. Because while you and I look at that balance sheet and see a disaster, the vultures or the smart money, they see something else entirely.
This is the distressed asset angle the analysis report gets into.
Correct. This is not growth investing. You know, if you buy Apple or Microsoft, you're buying their future earnings growth. If you buy FRMI right now, you are buying their assets. You're effectively stripping the company for parts, at least theoretically.
The report points to the 13F filings. For those listening who might not track these, those are the quarterly reports where big funds have to reveal what they bought. And we're seeing names like Hiddenite Capital Partners and Empire Life Investments taking positions.
And you have to pay attention to how they are buying. Hiddenite is accumulating call options.
Which is a leveraged bet. They aren't just buying shares, they're betting on a spike.
So why would they do that? Because they've done the math on the parts versus the whole. Think about what FRMI actually owns.
Okay.
They have land in West Texas, which is fine, but land is cheap out there. What they really have are power rights. They have an interconnection agreement to pull gigawatts off the ERCOT grid.
And in 2026, getting a new interconnection agreement in Texas takes what?
Years, plural. The queue is completely jammed. It's a bureaucratic nightmare to get that much power approved. So FRMI is sitting on a cut-the-line pass for power.
I see.
Even if FRMI, the company, fails, that piece of paper, that right to plug in, is worth a fortune to someone else.
So the smart money is betting that the enterprise value, the $4.9 billion, is actually cheap compared to the replacement cost.
Exactly.
If Amazon or Meta wanted to build this themselves starting today, it might cost them $10 billion in 5 years just waiting in line.
Exactly. They're buying the time and the permits. It's like buying a condemned house because it sits on top of a gold mine. You don't care about the house. The roof can be leaking, the windows can be broken. You care about the claim underneath it.
The report makes a really interesting comparison here to illustrate this valuation gap. It puts FRMI next to the giants of the industry, Digital Realty, ticker DLR, and Equinix, EQIX.
Right. Now, those are real businesses. They have buildings, they have tenants, they have massive cash flow, and they trade at massive multiples, sometimes 50 or 100 times earnings, because the market loves that data center stability.
But FRMI is trading at just a fraction of that potential valuation because of the execution risk.
The smart money bet is simply this. The gap between project on paper and live data center is massive. If FRMI can bridge that gap even a little bit, the stock re-rates. It doesn't even need to be fully built. It just needs to be viable.
And to bridge that gap, they need one thing.
The new tenants.
That's the catalyst. The report calls it the hyperscaler grail.
Yeah, I mean, if they announce tomorrow that they've signed a lease with Microsoft or Oracle or Meta, the failed project narrative just vanishes instantly.
It goes from that to a
growth unicorn.
And that $8 stock price likely doubles overnight.
Or more. Because suddenly, that $4.9 billion market cap looks tiny compared to the future cash flows of an 11-gigawatt campus.
So that 11% jump we saw today, that's the market sniffing around.
It's the market pricing in a probability. Maybe there's a rumor, maybe the vultures are buying enough to move the needle. It's speculative, but it shows the sellers are exhausted. Everyone who wanted to panic sell has already sold.
Speaking of sellers being exhausted, let's talk technicals. I know some people think technical analysis is like astrology for finance bros.
It can be if you misuse it. But in the absence of news, the chart tells you the psychology of the crowd. It tells you where the pain points are.
The report flags a specific pattern that happened today. A bullish engulfing candle. Could you walk us through that for the listener who doesn't stare at charts all day?
Sure. It's a strong reversal signal. Visually, imagine a red bar for yesterday where the price dropped.
Right.
Today, you get a green bar. The bullish engulfing part means today's green bar was so big, it completely swallowed the previous day's red bar. It opened lower than yesterday's low and closed higher than yesterday's high.
So in plain English, the buyers just completely overwhelmed the sellers today.
It represents a violent shift in momentum. It usually happens at a bottom. It tells us that at $7.20, which was the low, there are enough people willing to step in and say, that's too cheap, I'm buying.
That 720 number seems critical. The report calls it the floor.
It is the line in the sand. If the price holds above 720, the technical traders will start targeting the next levels up, $9.50, maybe $10 to fill the gap.
But if it breaks 720,
look out below. Then you're in price discovery mode, potentially heading to $5 or lower. That means the market has lost faith in the asset value.
so what about the analysts? Usually when a stock crashes 78%, the analysts downgrade it to sell. But the report says 57% are still at strong buy. Are they asleep at the wheel? Or do they know something we don't?
It's the lag effect. Wall Street analysts are slow ships to turn. A lot of those strong buy ratings are leftovers from the IPO days. They're based on the potential of the 11 gigawatts. They haven't all updated their models to reflect the tenant cancellation.
So don't blindly trust the buy rating on your brokerage app.
Never. However, look at the price targets. The average target is 27.33. The high is 37. Even the lowest target on the street is 20.
And we were at $8. That is a massive disconnect.
It implies that if the company survives, it's a 3x or 4x bagger from here. But again, that if is doing a lot of heavy lifting.
There are two other factors adding fuel to this fire. We have to talk about the short interest.
It's over 15%.
Which is high.
Very high. For context, anything over 10% is considered crowded. 15% means a lot of people, hedge funds, retail traders, are betting this goes to zero. They are borrowing the stock to sell it.
But that creates a coil, doesn't it? A short squeeze setup.
It does. I mean, think about the mechanics. If FRMI announces a new tenant, the stock spikes. Those short sellers are now losing money. To stop losing money, they have to buy the stock back.
And their buying drives the price up further, forcing more shorts to cover.
Exactly. It creates a feedback loop, a virtuous cycle for the bulls, a nightmare for the bears. We call it a face-ripping rally. It's violent and it's fast. That's what those call option buyers might be betting on.
And the second factor is insider ownership. The report says it's around 45%. That seems incredibly high for a publicly traded company.
It is very high. It means the founders, the early venture capitalists, and the insiders still hold almost half the company.
And how do you read that? Is that good or bad?
In this context, it's mostly good. It means they haven't dumped their shares and run for the hills.
Right.
They're eating their own cooking. If the stock goes to zero, they lose the most. It aligns their incentives with yours. They are desperate to make this work.
So let's just step back and look at the whole picture. We have a stock that has crashed. We have smart money buying call options. We have a technical reversal signal. We have high short interest ripe for a squeeze and massive insider ownership.
It is a powder keg.
But the fuse is burning. They're running out of cash.
It's the ultimate binary bet.
Let's break down the verdict from the report. Trap or treasure?
It depends entirely on your risk profile. The report rates this high risk, high reward. This is not for your retirement fund. This is for your Vegas money.
Okay, give me the bull case. If I buy today at $8, what am I hoping for?
You're betting that the smart money is right about the asset value. You're betting that within the next 3 to 6 months, FRMI announces a new partner for Project Matador. If that happens, the stock fills the technical gap to $10 immediately and then fundamentally trends back toward that $16 to $20 range.
So potentially doubling your money in a pretty short time frame.
Easily. If the thesis plays out, it's a multi-bagger.
And the bear case.
The bear case is grim. The class action lawsuits drain the remaining cash. No tenant signs.
Yeah.
February comes and goes with no news.
Then what happens?
Dilution. They'll have to sell more stock at rock bottom prices just to pay the electric bill. That crushes existing shareholders. The stock likely breaks that 720 floor and just drifts into penny stock territory.
It really is all or nothing.
And we have a specific date to watch. February 20th, 2026.
Earnings day.
Though, as we said, there are no earnings. It's really update day.
That call will be the most important hour in the company's history.
If the CEO gets on that call and says, "We're in late-stage talks with a Tier 1 hyperscaler," the stock flies. If he says, "We continue to explore strategic alternatives," which is corporate code for "we have nothing," then we crash.
So what's the takeaway for the listener? We're not financial advisors. We never give financial advice. But how should they process all this?
I think you have to view FRMI as a battleground. It's a battle between the accounting reality, which is awful, and the strategic reality, which is unique. There are very few places on Earth where you can plug in 11 gigawatts of AI compute.
It's that scarcity value.
Exactly. If you believe the AI boom continues, that land is valuable. The smart money isn't betting on FRMI, the management team. They're betting on FRMI, the landlord. They want the dirt and the power.
That helps clarify the 11% jump today. It's not everything is fixed. It's just the odds of survival just ticked up a bit.
Right. But keep your eye on 720. That's your stop loss. If the smart money stops defending that level, the thesis is broken.
This is fascinating stuff. It really highlights the difference between investing in a business and investing in a situation. This is a special situation.
It's the wildest corner of the market. It's where fortunes are made and lost in days, not years.
I want to leave everyone with a thought to chew on. We always hear that cliche about the gold rush. Don't dig for gold, sell pickaxes and shovels.
The safe bet.
The safe bet. NVIDIA is the pickaxe seller.
Right.
But Fermi is the guy who bought the barren patch of desert where everyone thinks the gold is. He hasn't found a nugget yet. He's thirsty, he's broke, and he is tired. But if he hits a vein, he becomes the richest man in the valley.
And if he doesn't, he dies of thirst in the desert.
That's the gamble. Thanks for diving in with us. We will be watching that ticker on February 20th.
Until next time.
Don't forget to like, share, and subscribe for more.